From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm David Moss of Fox 8, guest hosting the Financial Quarterback.
And I'm Jim Lineweaver, your financial quarterback since 1993.
Okay, so are you frustrated with your bank savings interest rates? Well, guess what? Jim has a few options to get your money working harder for you.
We do, Dave. But I want to point out that, on average, if you look back at the S&P 500 since 1957, it's been averaging around 10%. That's according to Seeking Alpha. But in a year with, market uncertainty, constant volatility, and rising interest rates, maybe that's not the right alternative for some people. So there are CDs and bonds that are paying, and as long as you're with an independent person that can shop these around the market, around 5.5%, and we've seen as high as 7% in bonds.
Yeah, the Fed's continuing to raise rates, so there is a good chance that rates will continue to rise, and there is a way to take advantage of this, right?
Yeah, CDs are fixed instruments, so the rate, that's rising isn't really going to affect you if you can hold on to them now for a little while. But we can also stagger your purchases and build you a CD ladder, which will let us, keep layering in new CDs as interest rates rise, so you're not penalized on that, and you can actually benefit from the phenomenon that's going on now.
Yeah, and just keep in mind the term. Different interest rates will be offered for different durations. CDs also have the advantage of being FDIC insured up to $250,000.
They do, but also let's bring in bonds as another strategy. Now, the FDIC insurance is one thing that CDs are able to offer that bonds do not. However, bonds may pay a slightly higher interest rate because you're going to take on a little bit of additional risk. So, for example, what we're considering right now or seeing in the open marketplace with good quality bonds, not junk bonds, is high as 7%.
Yeah, so there's a lot of different types of bonds, like corporate bonds, municipal bonds, and even United States Treasuries.
Yeah, and with bonds, it's going to really come down to the quality, the duration, and also the tax status. So different maturities will pay out differently and have some different values. So for example, one of the advantages to municipal bonds is the tax status. So currently, they are paying close to corporate bonds, and they can be up to triple tax-free, meaning that they are going to be exempt from federal, state, and local taxes. And when you factor in the taxes, they usually mean a higher rate of return to the investor.
Mm-hmm. And you use different strategies for holding bonds, including a bond ladder. And this allows you to layer the bonds in order to take advantage of rising rates. And the downside of bonds is you'll have more risk than CDs, I guess, especially credit risk.
Yeah, you will. So bonds and CDs are both a bit more conservative than what we usually talk about on the show. But generally speaking, if your time horizon is long enough, the S&P 500 with those historical averages that I mentioned might win out. So however, with the combined market volatility that we're seeing, the uncertainty with rising interest rates and what the Fed's doing, a lot of investors can seek other options. So if you have cash you'd like to get working more efficiently for you, but you don't like the risk of the stock market, give us a call. So remember, we're always here to help.
And stay tuned for Fox News Sunday.